event, rather it is more about the disclosures, transparency, and the right set of communication which happens in these events. I think secondly, if you look at what has changed also is the generational impact over last 2 decades, especially when generally the second generation companies used to come to markets and hit the markets and create value, versus many startups or first generation entrepreneur coming out for a public listing and unlocking the value. I think for these promoters or the first generation entrepreneur, I think probably these, even the capital market for some of them is the first set of liquidity event. Some of them don't even run through the PE route when they get some sort of a option of liquidity, and hence practically their personal concentration of capital is completely into the same set of assets. So it's a fair chance for these young entrepreneurs to make some chunk of capital and convert it for them. So we even see when large corporates like from the Korean companies nowadays have set examples, then they are making money. So certainly market has appetite to accept the fact, get along with it, and depend largely on the disclosures, transparency, and the long-term credibility that could potentially come out from the historical numbers as well as from the governance practices in the company. So this really matters less than it used to matter a decade back. So markets are changing, thought process change. I think we are a very mature capital market today.
I'll be very practical. I think how the market takes depends on the mood of the market at that point of time. Right now, the demand for equity is more than supply, and therefore the market takes it positively. In a very different market, I think even 5,000 shares being sold is taken negatively. So I think it is the mood of the market. See, having said that, just because a promoter is selling should not be pursued positively or negatively in this true sense. Like, say, if I happen to do an IPO of my company, there's no requirement of capital in the company. So unless it is an offer for sale, I will not even get permission to do an IPO because there's no need for capital. And there will be compulsion of listing. Maybe you want to have your people make some wealth out of it. Maybe you also want to diversify your risk to some extent. So I think there are reasons for it. Obviously, there have been instances where the companies completely has been sold off. And I'm amazed that companies which have zero promoters are now trading at the valuation at which they are trading at. It is purely demand and supply. So I would be very practical. I would say depending on demand and supply, the market will take it positively or negatively.
Okay, so the mood of the market is what it is. Since I come from the debt side of the capital markets, I quite often see that whenever there is a debt-related, expansion in a company, listed companies typically tend to be a little wary of that, because they think they'll lose market value. The flavor of the season is probably a debt-free company is better. So my question to you, Sanjay, is that, how do you look at, this interest burden, impact on EPS when you take decisions in your organization?